Welcome to the deep dive. We are unpacking an absolutely wild week in the markets for you today.
Yeah, wild is definitely the word for it.
It really is. We're looking at data from early March 2026. And the whole mission for our conversation right now is to figure out a really critical question. Is the financial sky actually falling, or is the great market narrative just violently shifting beneath our feet?
Right, and it's a distinction that matters immensely for anyone allocating capital right now.
Exactly. And to guide this analysis for you, we are pulling from two incredible sources. First, we have a detailed weekly market wrap transcript from a prominent investor who is breaking down the real-time volatility.
Which is fantastic for getting that immediate boots-on-the-ground perspective.
And second, we are digging into the latest Druckenmiller dashboard that tracks macro signals and market valuations, giving us that massive 30,000-foot view.
It is a fascinating combination of sources. You have real-time market reactions clashing directly with these huge, overarching macroeconomic indicators. It paints a very complex, contradictory picture of where the global economy sits right now.
It does. But before we jump into those contradictions, just a quick note for you. To access more advanced researches, applications, and our latest published personal intelligent multi-agent deep value intelligence, welcome to subscribe on deepvalues.ai and research.deepvalues.ai.
And to track total market temperature, welcome to search and download the iOS app Buffett Indicator from the Apple App Store.
Perfect. And of course, disclaimer time. All analysis today is based on publicly available sources and may be subject to revisions or differing interpretations. All contents from this channel is for educational and research purposes only and does not constitute investment advice. Conduct your own due diligence before making investment decisions.
And if you'd like to access wider topics, including life and investing philosophy, please subscribe to our sister channel at Deep Values. Don't forget to like this video. Much appreciated.
Okay, let's unpack this. We really have to start with the biggest news of the week, which triggered a massive geopolitical shock.
Yeah, you can't talk about this week without starting there.
Right. So over the weekend, the U.S. and Israel bombed Iran. And this resulted in the death of Ayatollah Khamenei and much of Iran's top leadership. Now, obviously, this is a historic global event. But for our purposes today, we are looking strictly at how the financial markets reacted.
Exactly. How did the capital move when the news broke?
Well, as you might expect, as the news broke over the weekend, traditional safety assets surged. Oil, gold, silver, they all went up. But when we look at the weekly market wrap, there was a massive aha moment regarding Bitcoin.
Yeah.
It went down.
What's fascinating here is how this completely debunks the narrative that Bitcoin is a hedge for uncertainty.
Right. I mean, that's been the story forever.
Exactly. For years, the prevailing argument has been that Bitcoin acts as digital gold, that it's a safe haven, a decentralized hedge against geopolitical crisis. But the data from this specific weekend tells the exact opposite story. When true global panic set in, Bitcoin did not act as a hedge.
Instead of moving with gold, it moved exactly like a high beta technology stock.
Precisely. When the Nasdaq opened significantly lower on Monday and then eventually clawed its way back, Bitcoin followed that exact same trajectory. It correlated directly with tech stocks, not with precious metals.
But the investor source points out something really interesting about retail investors during this. They just kept buying the dip.
Yeah, stubbornly holding on to that digital gold narrative, even when the real-time market behavior completely contradicted it. It just shows how sticky a financial narrative can be.
It really does. And the volatility we saw extended way beyond crypto. The weekly wrap highlights the whiplash in travel stocks, airlines, cruise lines, booking companies. They tanked on Monday morning.
Which is a logical reaction to a potential regional war breaking out.
Right. But by Friday, well, actually, the source notes they rallied by Friday, people seemed to realize the U.S. would win and the Middle East might be remade. But then by Tuesday, reality set in.
The timeline of that volatility is crazy. The market narrative shifted to this optimistic assumption of a swift victory, but then reality digested that it wouldn't be a short war at all.
That level of whiplash brings us to the bond market, because this showed perhaps the most anomalous reaction of the entire week.
The Treasury yields.
Exactly. Normally in a crisis, we see a massive flight to safety. People dump risky assets, they buy U.S. Treasury bonds, demand goes up, yields drop. But not this time. Yields actually went up.
And the mechanics of why those yields went up tell us everything about current market psychology. The flight to safety was completely overpowered by the fear of renewed inflation.
Because of the oil prices spiking.
Right. Because oil prices shot up over the weekend, the market immediately panicked about inflation getting sticky again. Investors demanded higher yields to compensate for the risk that central banks might have to keep rates higher for longer just to fight that oil-driven inflation.
It just shows that inflation anxiety is still the absolute dominant force, even during a massive geopolitical conflict. And this led to extreme global volatility all over the place, like the Korean Kospi.
Oh, that drop was historic.
Yeah, the benchmark Korean index dropped 12% on Wednesday, 12%, and then rallied 10% on Thursday.
A swing like that for a major national index shows a market that is deeply, deeply on edge.
Which is exactly why the Druckenmiller dashboard is such a vital second source for us today. Because amidst all this wild headline-driven panic, you have to ask what the big picture looks like. We need a macro temperature check.
And right now, the valuation metrics on that dashboard are flashing bright red.
Let's break those down, starting with the Buffett Indicator. So for context, this measures the total market capitalization against the GDP. Basically, seeing if financial assets have detached from the actual real-world economy. Historically, a healthy average sits around 80 to 100%. Right now, the dashboard reads this at 216 to 224%.
The implications of that are staggering. The market is priced at more than double the entire economic output of the country, and the Shiller-PT ratio confirms this.
That's the one that smooths out earnings over 10 years, right?
Right, the cyclically adjusted price-to-earnings ratio. It's sitting near 38.7 to 39.8 right now. To put that in perspective, that is the highest reading outside of the absolute peak of the dot-com bubble. It indicates severe structural overvaluation.
The market is priced for absolute perfection. But this raises an obvious question for you listening. If the geopolitical situation is a mess, inflation fears are back, and valuations are at historic extremes, why hasn't the entire system just collapsed?
Because there are moderating factors. The dashboard is very clear in pointing out the green and yellow signals that are acting as shock absorbers right now.
The liquidity.
Exactly. Broad financial conditions remain loose. The dashboard rates this as green. Credit is still highly accessible, meaning capital is still freely flowing to support these risk assets.
The dashboard also notes the Treasury spread. The 10-year to 2-year spread is positive, sitting at roughly 0.60%. So just to clarify, when the 2-year yield is higher than the 10-year, that's an inverted yield curve, a classic recession signal. But since it's positive right now,
it removes that immediate mechanical recession signal. So what does this mean? When you synthesize all of this, the overall total risk score is an 8 out of 20.
Yeah, 20. Okay.
Right. The dashboard classifies the market regime as neutral with mild fragility. We are in a late cycle environment. It's heavily overvalued, yes, but there is no systemic stress yet.
Yet. That word is doing a lot of heavy lifting. Because this brings us back to our investor source. While the macro dashboard shows broad stability for now, the source is seeing massive cracks forming in private credit.
The narrative there has violently flipped from bullish to bearish.
Violently. Private equity stocks have been utterly obliterated year to date. Apollo and KKR are down 24 to 26%. Blue Owl is down 31%.
It's a textbook example of how quickly easy money narratives unravel. Private credit exploded over the last decade when rates were zero. But now we are seeing the cockroaches come to light.
Yeah, the source actually lays out 4 specific pieces of bad news. 4 cockroaches. Let's explore these. The first one is outright fraud.
In the UK.
Right. A UK-based lender called Market Financial Solutions. They manage a $2.4 billion loan book, and they are liquidating due to double pledging assets. Now, for you listening, double pledging is basically like taking out 2 separate mortgages on the exact same house without either bank knowing about the other.
It's a fundamental breach of trust. And the exposure here hits major players. Barclays, Apollo, Jefferies, Wells Fargo. What stands out to me is that this is the third lending fraud exposed in just the last 6 months in private credit.
The third one.
It represents a massive systemic failure of basic due diligence. During the boom, lenders were so desperate to deploy capital that standard risk management just vanished.
And that leads right into the second piece of bad news, gating. Invico Capital, which has about $3 billion under management, is getting massive institutional redemption requests. People want their money back.
And they can't give it to them, so they adopted a, quote, structured liquidity management plan.
Which is just a corporate buzzword for locking the doors.
Exactly. They are gating the fund. But the critical detail is who is panicking. It's not retail investors reacting to a scary news cycle. It's institutional money. When the institutions run for the exits and the fund has to restrict redemptions, the trust in the asset class is broken.
Which makes the third piece of news so wild. This involves Blackstone. They have an $82 billion private credit fund called BCR. Redemptions hit 7.9%, but they have a hard limit of 5%.
So normally they would have to gate the fund just like Invico.
Right, but to avoid looking like a distressed fund, Blackstone actually increased their limit to 7%. And here's where it gets really interesting. They used $400 million of company and employee capital to backstop the rest.
You have to consider the psychology of that decision. Gating an $82 billion fund would cause a catastrophic PR disaster. So instead, they are quietly using their own employees' money to stop a bank run.
It's staggering. It proves what the source said. Getting into private credit was easy, but getting out is a completely different story.
And a big reason getting out is so hard is because of how these assets are valued, which is the fourth piece of bad news.
BlackRock TCP Capital.
Right. It's a small $350 million public business development company. They marked a $25 million loan to an Amazon aggregator down to zero. From par meaning 100 cents on the dollar to absolutely nothing in just 3 months.
From perfect health to zero in 90 days.
It highlights the extreme danger of mark-to-model accounting. Public stocks are mark-to-market. You know the exact price every second. But private credit uses internal models to guess the value of a loan. If a loan goes to zero that fast, it means those previous mark-to-model valuations were essentially fictional.
Which makes the mailbag section of this wrap-up so chilling. The source mentions an interview with Tom Gober. He talks about how private equity firms are actually buying life insurance companies to park these risky, long-duration private credit loans.
And they are hiding the leverage overseas. They use offshore captive reinsurance to keep these toxic assets off the standard regulatory radar.
So the danger is just brewing completely under the surface.
Right out of sight.
Wow. Well, the contagion isn't just in private credit. The wrap-up points out huge warning signs in other sectors, like solar. Sunrun stock dropped 35% following really bad results from First Solar.
The solar sector is getting hit from two different directions. The source's market analysis notes that commercial solar is hurting due to President Trump's anti-renewable policies. But the residential side is failing for purely economic reasons.
Right, because residential solar relies on consumers borrowing money. When rates were zero, financing a $30,000 system was easy. Now, with high rates and federal subsidies gone, the math just doesn't work for the consumer.
The bottom is definitely not in for those stocks.
And then there's health insurance, usually a safe haven. But Elevance, a huge United Healthcare competitor, is down 17% this year because CMS is suspending their Medicare Advantage enrollment.
And the reason for this suspension is almost hard to believe.
It really is. I love this detail. Elevance was supposed to upload data to a CMS website from 2015 to 2023. Instead of using the portal, they repeatedly mailed CMS a physical USB flash drive.
For 8 years.
For 8 years. And CMS couldn't even open the drives. Elevance ignored all the warnings and just kept the overpayments.
It's incredible. The source compares this to the sanctions the Fed put on Wells Fargo back in 2017. It is basically an excommunication from the industry. It's going to crush their star ratings and their revenue.
Massive self-inflicted wound. But speaking of structural blows, let's talk about the software and AI sector, because this might be the most terrifying part of the wrap-up. MongoDB beat Q4, but gave really weak Q1 guidance, dropping 23%. But the massive shocker is Block.
The payments company.
Yeah. They're laying off 4,000 employees. That is 40% of their entire workforce.
The number is huge, but the reason is what we really need to focus on. The CEO explicitly stated that AI is allowing them to operate with fewer employees.
He didn't blame the macroeconomy. He just said, AI does the work now.
Exactly. And this raises a terrifying question. Is this a company-specific move by an aggressive CEO, or is this the very beginning of massive structural white-collar layoffs across the board?
If an entire tech company can instantly wipe out 40% of its staff because of AI, that changes everything.
If we connect this to the bigger picture, the contrast is incredible. On the surface, you have a market propped up by historical valuations. The Buffett Indicator is flashing bright red, yet the dashboard says things are neutral because liquidity is loose.
But beneath the surface, it's a completely different reality. The easy money narrative in private credit is unwinding. Fraud is topping up. Institutions are panicking. And AI is beginning to cause brutal structural shifts in the labor market.
It all comes back to how fragile these systems are when the environment changes.
It really reinforces the core takeaway for you today. In markets, narratives can turn on a dime. Getting into things like private credit or residential solar during the boom was easy. Getting out is a completely different story.
When the liquidity dries up, the true risks are finally exposed.
Exactly. Which leaves us with a final provocative thought for you to ponder. We spent all this time talking about the macro dashboard, the CPE ratio, the Buffett indicator. But if artificial intelligence can instantly wipe out 40% of a major tech company's workforce, and if private credit firms are successfully hiding massive leverage in offshore life insurance accounts.
Are our traditional macro dashboards even measuring the right things anymore?
Right. Are we relying on tools built for a world that doesn't exist? Are we just flying blind into a completely new kind of economy? It's something you really have to consider when looking at this data.
It is the ultimate question for this new era of investing.
Absolutely. Well, thank you so much for taking this deep dive with us today. Keep asking those hard questions, and we will catch you next time.